All right, I think we're going to get started here. So once again, thank you everyone for joining us for our webinar, SMB, M&A, How to Buy a Small Business and Become Your Own Boss. With us, we have Wright Lewis here, who is one of our partners here at DBL. And why don't you introduce yourself, Wright?
Thanks, Holly. Yeah, my name is Wright Lewis. I'm a partner at Dunlap Bennett Ludwig. We are a business law firm that is dedicated to representing entrepreneurs and small and medium-sized businesses. And that starts from formation and goes all the way through exit. My particular practice is focused on three primary areas, which are business mergers and acquisitions, debt and equity financing, and just providing general counsel for all kinds of matters that arise throughout the business life cycle. So everything from entity formation through contract drafting and negotiation, equity comp, all of that. And then our firm also has a deep bench of talent to handle all kinds of related matters like patents and trademarks, litigation, government contracting.
Mhm. Awesome. Thank you for that introduction. So let's just get right into it. So I'm going to be asking you some questions and you'll be sharing your expertise in answering these so we know a little bit more about this topic. So starting off, why should I buy a business instead of just starting one?
Yeah, that's a great question. I mean, it seems like maybe it would be less risky to just start a business. Doesn't require any cash or a personal guarantee up front. But when you buy a business, there's a few benefits that maybe actually make it less risky. So first of all, you have immediate cash flow. So if you pay the right price and you don't over leverage the purchase, you'll have cash flow from day one, and you don't have to wait years to pay yourself a decent wage like many people do with startups. Um, you also have a proven business plan. So the business has probably, whatever business you buy has probably been around for 10, 20, 50 years. It has loyal customers. Ideally, you're vetting it. It's going to have a good reputation, knowledgeable employees, and proven processes. So the heavy lifting has been done. And then risk. Yeah, of course, you're going to have to personally guarantee a loan, most likely, unless you have a lot of cash sitting on the sidelines. But if you do your due diligence and you pick a good business, the chance of failure is a lot smaller than with any startup.
Awesome. So where can I find a small business to buy?
There's a bunch of places that you can look. And I think some of the answer depends on what type of business you're looking for, or maybe what geography you're looking in. There are lots of business brokers and investment bankers out there. They generally represent sellers who've decided to sell their business, and some of the good things about that is they can help set reasonable expectations for the sellers regarding what prices, what kind of multiple, and what the price should be, what a reasonable price is for their business. They can also be a valuable asset in getting the deal to close and dealing with difficult discussions, particularly related to business terms. And then, if you're looking in a certain geographic region, some brokers just work, in a geographic area. Some are all around the country. Others specialize in a particular industry. And so, depending on what you're looking for, you'll want to target those types of brokers to reach out to. There's also a few websites that are sort of like almost like brokerage sites. They're sort of like a Zillow for business buying. One of them is called bizbuysell.com. And then there's also Flippa, which is more focused on internet-based businesses. And then if you really want to go the extra mile, you can do proprietary outreach, which would be anything from just researching businesses in your area that you might be interested in purchasing, and then reaching out to them either in person or on the phone, or sending out targeted mailing. It's a lot heavier of a lift, but some people think that they get off market deals. Maybe it's better. There's pluses and minuses to the off market deals, but those are some of your options.
Okay, awesome. So then if I do that, how can I finance my acquisition of a small business?
Sure, yeah. I mean, there's lots of ways. One of the most popular ways for, lower middle market companies that are trading around, 5 million or less is to use an SBA 7A loan. You can borrow up to $5 million, and it can be used to fund the majority of your purchase price. There is a minimum 10% buyer equity injection, so there does need to be some cash brought to the table at closing. But anything more than 90% leverage is kind of suspect anyway. And you're gonna have problems, especially with current rates with debt service. There's a couple other limitations on transaction structuring when it comes to SBA loans. There can't be an earnout. The seller basically can't have any interest in the business post-closing. So at least currently, there's some proposed changes to that, but currently you have to buy 100% of the business. And seller transition assistance can't exceed 1 year. So the seller has to go away after that. Also, the business you're buying must be U.S. based. It must be for profit. It has to be a small business under SBA guidelines. And then there's some kinds of businesses that aren't eligible. They're generally related to investing or lending or gambling, speculative types of activities. There's also 504 loans, which are for acquiring fixed assets, basically real estate. And they have slightly different terms and conditions, including potentially longer maturity dates. Another thing you could look at is just a conventional loan. They don't have to meet the SBA's lending standards, but you know, you just have to meet the financial institution's internal guidelines.
Okay. Are there ways to reduce the amount of debt that I'm taking on to acquire the business?
Yeah, and I did only just mention loans to acquire, and that is the most common way. But you could also raise money from friends and family or from investors. I would want to note that raising money is a securities offering, even if it's a private offering. And you do need to follow specific rules in order to qualify for an exemption from registration, both with the SEC and state securities regulators. So if you're looking at doing that, you should definitely discuss the requirements with your attorney if you're planning to raise outside capital. Another option would be to ask the seller to fund part of the purchase price. I've seen everything from, I've actually seen 100% seller finance transactions, which is incredible and doesn't happen every day. But you can get sellers generally to finance part of the purchase price. Usually it's more on the order of 10 to 20%. But that would reduce your equity injection. It can you still have to bring, I think, at least 5% to the table if you're getting an SBA loan. But also the seller note would be subordinate to any commercial loan. So that SBA loan or your conventional loan, the lender is going to require that the seller's note be subordinated to theirs and potentially be on standby. So meaning no repayment of that seller note until you've paid off the SBA loan, which can be hard for a seller to agree to. But if they're looking for a higher price and you can't maybe agree on price, having a seller note kind of bridge that gap could be a good way of doing that.
Okay, so it's good to know that there are options. Do you have any other tips related to funding the acquisition?
Yeah, I mean, you could also obtain, and you probably should obtain, a line of credit from your lender at closing, even if working capital is part of your transaction. You don't necessarily want to be, you definitely don't want to be low on cash. And most lenders, especially if you're borrowing, if you're getting an SBA loan or conventional loan, they're going to want you to have a line of credit with them as well, just because it protects them and as well as protecting you in the business.
Okay, great. I also just wanted to remind all the audience members that if they have any questions throughout this webinar, please feel free to enter them into the chat and we can address them after the webinar. So just wanted to let you know that we will get to your questions at the end. So moving on, how do I determine if a business I'm interested in buying is a good business to buy?
Yeah, so initially, once you get, looking at some, confidential information memorandums, some information from brokers or online, you get interested in what you see that's preliminary. You'd reach out to the seller, ask for, they're going to have you sign an NDA, and then they'll send you some financial statements, usually balance sheet, income statement, cash flow statement. You can look to verify the claims made in the postings or in the collateral that you received from the broker or the website. Verify the business's profitability and evaluate the sources of income and expenses and cash flow, and kind of think about what areas there could be for improvement. And then use that also to determine what's an appropriate purchase price, and then model your profitability after paying your loans, which, is not likely to be something that the business is currently doing. And then you can have a conversation with the seller. Some brokers try to gatekeep that relationship, but generally speaking, I think once you've been vetted by the broker and they see you as a real possibility, they'll let you talk to their seller. And that's a process where you want to use that to get to know the seller. You're going to probably be working with them at least for a little bit, and you want to identify any risks specific to the business. So, what are their things about customers? Do they have a lot of concentration? What's their retention like? How much does it cost them to acquire customers? What types of, how are they doing that currently? Ask them some questions about their suppliers and vendors. What is the seller's role in the business? You're going to be replacing that role, and maybe they're playing more than one major role. So that's some cost you might need to model in. And then special circumstances like specific licenses, exclusive relationships, other things that could be risks or benefits depending on the situation.
Mm-hmm. Okay.
And then, once you're done, once you're done with the preliminary due diligence, generally you'd put in a letter of intent at that point if you're satisfied and you want to move forward. Once the letter of intent is accepted, that's when you would launch into sort of a full due diligence process. So that's more in-depth financial due diligence like tax returns. Maybe you get a quality of earnings, which is an in-depth analysis of the target company's financials. Includes things like sources and quality of revenue, so recurring versus non-recurring, customer concentration, like I mentioned, what products and services are their most or least profitable. So you get some insights into the business. Also looking for things, abnormal accounting practices. Obviously, fraud is a possibility, so definitely important to make sure you have at least an accountant, a sophisticated accountant, looking at these documents for you. And then any unusual or non-recurring income or expenses, and any related party transactions, things that you may want to pull out or add back to your analysis. You would also do a working capital analysis to determine, how much working capital does the business need now, and then how much will you need once you take over, which may not be the same. Do some legal due diligence as well at that point, including contract review, reviewing the cap table and corporate books and records, determine, who are the owners of this thing? Is there any potential issue or question as to, who actually owns the company? That could be a major problem. Is there any litigation, past, pending, threatened? Kind of want to get an idea of that. And then employee matters. Have they been classified correctly, or is this much more profitable because they've been misclassifying employees as independent contractors? Any employment or labor disputes. And then you might do a site visit if you didn't already do that in preliminary due diligence, and meet, then you're getting closer to closing, meeting with key employees and customers and vendors at that point.
Okay. So let's say I've done my preliminary due diligence and I want to make an offer now. What's the next step for me?
Yeah, so as I sort of previewed there, the next step is to submit a letter of intent to purchase the business. The letter of intent is just a non-binding offer letter that outlines the key terms of the deal. The seller is going to want a detailed LOI because the seller loses a lot of leverage after they sign. After they sign, they're now under exclusivity for some period of time, usually somewhere between 60 or 90 days. And so they lose the ability to shop the business, and they're losing time. And so they lose leverage after they sign the LOI. So they want more terms in the LOI, so there's less to negotiate later, and they know that they'll be happy with the terms. The buyer just wants enough detail that there won't be any major surprises that cause the seller to back out later. But buyer, generally doesn't need quite as much detail in the LOI. So some of the common terms that you'd see are obviously the transaction structure. So whether you're doing an asset purchase or a stock purchase, most lower middle market deals are asset purchases. There's a few exceptions to that. But basically, an asset purchase allows the buyer to choose which assets and liabilities of the business that they want to acquire and which ones they don't. It gives the buyer less exposure to liabilities of the business, known and unknown. So things like, unpaid taxes or withholding, lawsuits, employee benefits issues, things like that. But I mentioned there's some exceptions. In government contractors are often structured as a stock purchase, mainly because novating those contracts with the government it can be a headache. And then also maybe if in some of the private equity transactions, they'll ask sellers to roll over some equity. It's not as common in individual, purchases and sales. Or purchases of less than 100% of a business would have to be generally has to be a stock purchase, unless it's sort of a liquidation of some assets or a limited sale of assets. Then obviously the purchase price is a major term that goes in the LOI. Payment terms. So, how much cash at closing? Will there be a seller note or maybe just a holdback? A holdback is just, when the buyer says, I'm going to pay you, $1 million, we're going to hold back $200,000 for, 18 months to make sure that what you're telling us about this business is true. And then we can offset from that whole, we can pull that money out of the holdback if there's a problem. Another alternative to a holdback is an escrow, where you actually have a third party who holds the money. Maybe there's an earnout, which incentivizes the seller to stick around for maybe 1 or more years, and kind of prove that the business is what they say it is. Earnouts were particularly useful with companies that benefited from COVID, because maybe they had abnormal earnings during COVID years, and so the earnout says, well, if you really think that the earnings are going to keep this pace, then we'll pay you based on those targets, or not if we don't meet them. And then, maybe some equity rollover, although that's usually, like I said, pretty much just in PE type purchases. And then you're going to have something about working capital in there, kind of standard term, sort of minimum viable term is a normalized level of working capital to be determined during due diligence. I would note that some smaller transactions skip working capital because it's hard for the seller to understand sometimes. It can end up blowing up deals. But I still think that it's a mistake not to include it for a buyer. The business needs working capital to operate now, and it's going to need it when you take over. Working capital is like gas in the tank, right? Like you wouldn't buy a car that was, that had an empty tank of gas. You can't even get it home. And that's sort of what working capital is. It's like, how much money are we going to need to run this business immediately after closing so that we don't have to add cash or, put gas in the car. And you don't want to be relying on a line of credit immediately after closing to fund just normal operations. And you definitely don't want cash flow problems affecting your decision making. So at a minimum, I would you want some working capital language in there and a requirement that some be left in the business. But at a minimum, you'd need at least language to address potential deferred revenue issues. So things like prepayments. Customers have prepaid you for, let's say maybe they've ordered something from you and it's on back order, or you have jobs lined up 6 weeks in advance or something. So they've made the payment, but you haven't done the work. You want to address that in the LOI and in the purchase agreement, how that's going to be handled. And then any employment or transition assistance that you need. There's a 1-year limit, as I mentioned before, if the purchase is funded with an SBA loan, although 1 year is way more than enough generally. Most business owners, especially when they're ready to sell, aren't really employable, particularly if you're going to be making major changes to the way their business runs. Business owners are incredible at what they do. Being employees is not one of them. And you're going to have some confidentiality provisions in there, which will be binding on both parties. That's one of the binding parts of the agreement. You might want to address a non-compete, especially if it's a major sticking point. And I think 5 years is pretty much standard at this point. Anything less than that is a little bit risky. You definitely don't want to buy a company and then have the seller go and start another one anytime soon. Exclusivity is another binding provision in the LOI. So the seller and their agents can't shop the business to other buyers while you're spending money on legal and accounting and other due diligence. It usually expires on the target closing date, whatever you decide that is, and can be extended by agreement of the parties. And then you'll have your target closing date, which is usually 60 to 90 days out. 60 is honestly kind of pushing it, especially if there's some lending that, a loan that needs to be acquired. And so then, this is the time you need to do your full due diligence, draft and negotiate the purchase agreement, employment agreements, and any other transaction documents, complete and review disclosure schedules, obtain financing, obtain third-party consents like landlord, lease, assignments, things like that. And also, get any insurance squared away so that there's no lapse in coverage, after closing. And then the last thing you'd put in there is any contingencies to closing. So if you want to say, I have to get a loan for this, and if I don't get the loan, then we're not going to close. Or, yes, I like this business, but let's say it's like a swim school, and you're in this strip mall and your lease expires in 2 or 3 years. Well, you're not even going to make the money back that you put down on the company in 2 or 3 years. So that lease expiring early puts you in a really risky situation. So maybe you want to say, well, we have to have the landlord extend that lease before we'll close.
Mhm. Okay, yeah, great points. So let's say the seller signed my letter of intent. What's next?
Yeah, so then you would begin that in-depth due diligence process that we talked about,
Mhm.
also drafting the purchase agreement and the other transaction documents. Unless something unexpected is revealed during due diligence, the negotiation of the purchase agreement is normally pretty limited to any terms that weren't specifically addressed in the LOI. And so items that are kind of commonly left to be negotiated in the purchase agreement, although not always, um, include things like indemnification obligations, how long those obligations survive after closing, whether there's any caps, and what those caps are, any sort of deductible on those obligations, or basket, which is two similar ways of doing the same thing. Things like defining what net working capital is, which is kind of gets into minutia, and people end up arguing over what's an asset and what's a liability. The working capital target, which is often left to due diligence to determine what a reasonable amount of working capital really is. Scope of the non-competition clause, so not necessarily the length of it, although sometimes that's left to the purchase agreement too, but like basically what is a competing business. We're defining what is competition, and the seller generally, unless they're fully retiring and ready to not do anything else, wants to limit the scope of that definition, and the buyer wants it as broad as possible because they don't want any competing from the seller. And then addressing other insurance requirements, whether or not there might be like tail insurance policies, or usually in larger transactions, there may be reps and warranties insurance, but not generally in some of the lower middle market. And then after that, assuming the parties reach agreement on those sort of somewhat sticky items, and the buyer secures their financing, just collect signatures and funds get wired where they're supposed to go, and the transaction closes.
Okay. Seems like a pretty complex item to go through. So when should I hire a lawyer, and what can I do to ensure my purchase is a success? What can they do to ensure it's a success?
Yeah, yeah. No, it's definitely not a DIY type project. Even a
Yeah.
smaller transaction, there can be some major pitfalls. And you don't want to go it alone for sure.
Mhm.
And you also don't want to hire a lawyer who doesn't do M&A on a regular basis. That, and ideally you don't want, if you're the buyer, you don't want your seller using their cousin who is a family law attorney. They may be a fantastic family law attorney, but it ends up being kind of a nightmare trying to get through even things like standard terms in that situation. So if you're the seller, I would say you actually want to hire your lawyer a couple of years before you want to sell, 2 to 3 years. And I would say, you don't want to wait until you're ready to retire to start the process of getting ready to sell. You want your business to be growing into the sale, and in order to maximize, the price that you receive for selling the business. And I mean, I've seen this many times. Sellers just don't want to put in the time, money, and effort necessary to grow the business once they're already ready to be done. And this also allows time for tax planning, especially if you have a much more valuable business. You may want to consider doing, some gifting strategies and things like that to reduce your estate taxes and things like that. There's usually most businesses have some legal issues to clean up, or at least contracts to tighten up, little things to clean up here and there. It gives you time to hire and train, an executive or someone to replace some or all of what the owner does, so that the business sells at even a higher valuation, because look, you don't need the owner, it's already running itself. And then you have more buyers, a larger pool of buyers who might be interested in buying a business like that. And then just putting systems in place to make the business more attractive. So a couple of years, I would say, if you're a seller. For a buyer, I would just say, before you submit that letter of intent. Oh, and sorry, one more thing on the seller. At the very latest, I would hire a lawyer before you hire a broker, because you're going to have an agreement with the broker to sell the business, and that's a contract that a lawyer should help you review as well. So that would be like sort of the very last time moment you should probably do it if you're a seller. Anyway, for the buyer, hire the lawyer before you submit your LOI. And an experienced M&A lawyer is going to structure the transaction to protect you and ensure that the seller is incentivized to make the deal a success also.
All right, awesome. Well, thank you so much for answering all those questions, Ray. Right now, I want to open it up to the audience and see if anyone else has questions that Ray can answer. If you want to submit anything in the chat, please feel free to, and we'll just wait here for a minute or two to see if anyone has any, and we can address them. Yeah.
Thanks everybody for coming. If you don't have any questions, and feel free to reach out if you want a little bit of time. Happy to give you some of my time to discuss anything specific.
Awesome, thanks, Wright. Looks like we've got someone typing here.
Likewise, somebody sent a message before we started about will this be focused on sellers? And it wasn't focused on sellers, but there's a lot of good information that I can share with somebody who's interested in selling. So feel free to reach out afterwards, and I'll be happy to set up a time to talk to you.
Yeah, awesome. Let's see. So we've got one question. I'm curious about valuations. Is that something your firm helps with?
So we don't do business valuations here in-house, but if you're looking for some good options, I do have some fantastic options at different price points and different detail levels. So feel free to reach out, and I can recommend a few really high quality valuation firms for you. Also, some brokers, if you're looking to sell, some brokers will do sort of a rough valuation and give you an idea too of, it won't be, you can't use it for, gifting or things that are tax related, but it'll give you an idea of what the business is worth.
Awesome. I also want to let everyone know who's on here. You will be getting a copy of this recorded webinar later today. So if you didn't come at the very beginning, or if you came a little bit late or missed anything or wanted to hear something again, you'll have access to this, as well as Wright's contact information. So another question we have is there a standard multiplier to be used to determine value of the business?
Yeah, George, that's a good question. It depends on the industry, really. There are very, and it depends on the business, the size of the business. Multiples tend to go up a little bit more with larger businesses, because they can attract people with more capital. I mean, it's almost that simple. But also because they can be run without, they can be run sort of absentee as more of an investment. So, mostly sort of lower middle market kind of SMBs are going to trade in the 3 to 5x range, 3 to 5 times. And that can go up like I said, if it's a larger business, if it's a more sort of, there's more processes and systems in place, or if it's growing faster. And then, it somewhat of it just depends on industry as well. I mean, you're going to pay a much higher multiple for a SaaS company than you are for an HVAC service company. And then government contractors, We do a lot of GovCon transactions, and government contractors. A lot of it depends on the size of the contractor. So, what their revenue is, like any other business, but also the types of contracts they have.
Okay. So we got another question here. Great information. How do I do proprietary outreach of a business I'm interested in that is not currently for sale? Specifically, where do I find financial information to see what business is worth, etc.? Also, do you represent clients out of state, like in Minnesota, for example?
Great question. So I'm based here in our Virginia, one of our Virginia offices. We have multiple offices in Virginia. I'm in our Tyson's office. I'm licensed personally in DC and Virginia. We do have attorneys who are licensed all around the country, in Delaware, California, New York, many places. So don't hesitate to reach out. Also, some of it may depend on where if the company is in a jurisdiction where we have somebody, the company that you're trying to buy, then we can help with that as well. So don't let that be a reason not to reach out. And then as far as proprietary outreach, really it's putting together a process to find a lot of businesses that are, usually it's people that want some specific type of business. And then so they will gather the information, the contact information for that business. You can either do that on your own, sort of scraping the internet and other sources for contact information, or you can buy lists from list brokers. And then really it's about finding out enough about the person or the owner to reach out to them in a way that gets their attention, and sort of you prove who you are and how serious you are, that you're not wasting their time. And tell them what you're about, and look, I'm trying to acquire this type of business, and yours looks interesting. Would you be interested in discussing selling? And if so, then you can start a conversation. It's more of a conversation starting. It's a much longer process. You start a conversation, you get to know them personally, whether they're serious about selling or not. At some point, you can then ask them for things like financials if they show some interest in selling. But proprietary outreach is a much more labor intensive process than using a broker.
Great. Thanks for that. Another question, is there any additional information that a seller could want because there are extra intangibles that they think are valuable?
Yeah. So, I'm trying to think about, any additional because of extra intangibles. The seller. I mean, maybe if you have an example of something, I can't think of anything offhand that the seller would want. I mean, the seller wants to know. Generally, sellers want to know that you have the money to buy the business and that you're going to take care of their people and their legacy. Those are the types of things sellers care about. Pretty much, that's about it, for the most part. And the multiple, again, is really, it depends on, it really depends on the industry, but a lot of times it's 3 to 5 times. It's called SDE, or you could call it EBITDA. But yeah, it does depend on the industry for that.
Okay. And then what are typical attorney costs for business less than 5 million in sales?
I'm going to give the lawyer answer, which is it depends.
Mhm.
It depends on a lot of factors, the type of business, the complexity of the transaction. I mean, less than 5 million in sales is usually not going to be too expensive. But again, it does depend on the type of the transaction. I mean, if you have one attorney involved and a not unrepresented party, prices go through the roof generally, like they double. If you have one M&A lawyer and another lawyer who is not regularly an M&A lawyer, the same thing kind of happens. It gets more expensive because you waste a lot of time explaining things, and trying to negotiate things that normally wouldn't get negotiated. So it really depends. And then the same thing goes for maybe if there's an overzealous firm on the other side. It's really almost like a personality situation. So it's really hard to say, to generalize that broadly. But most M&A lawyers are charging on an hourly basis somewhere between $4.50 an hour and $12.50 an hour, depending on what type of firm they're working for and the types of deals they're working on.
So a pretty big range, and it really depends.
Yeah.
Hmm. All right, well, we got someone else typing another question here, so we can just give them a minute. Great questions, you guys. Thanks for asking.
And George, if you want, you feel free to reach out afterwards and we can set up a time and I can discuss some of your questions with you and walk you through some of that stuff. Because I know I've seen you've had a few questions.
Okay, here's another really great question. Is there a printable list of preliminary due diligence you offer that I can download? I don't want to miss any important steps.
Yeah, we have a variety of lists depending on the types of businesses that you're looking at. And so, yeah, there are some that are the same with all of them. And so, yeah, if you want to reach out, I can get you a preliminary due diligence list.
Awesome. Okay, got a couple more people typing here.
By the way, a lot of what goes into the preliminary due diligence list is what matters to you, and for the type of company that you're buying, and what risks are you most concerned about. And some of that varies from company to company.
Okay. How long does the process take from execution of the letter of intent to closing?
Yeah, good question. Generally, it's 60 to 90 days. 60 would be is when we get the LOIs that say 60 days to target closing date. It's always a little ambitious, particularly if there's a financing component, and even more particularly if the financing is SBA related, because in addition to having your lender, the bank itself approve the transaction, once they get approval, they have to send it to SBA for approval as well, to ensure that the SBA will guarantee the loan. So 90 days is more realistic. For really simple transactions, so sometimes you actually kind of negotiate the terms in principle, skip the LOI, and do what's called a sign then close, where you basically negotiate the purchase agreement first, sign it, and then there are contingencies to closing. So you would actually sign the purchase agreement, then do due diligence, which is usually, again, that same sort of 60 to 90 days. And then once all the contingencies have been satisfied, then the parties agree to close. Still slightly different structure, but that's common in much smaller deals. Usually companies under $1 million.
Okay. Okay. Couple more questions coming in here. Does an M&A broker really add enough value beyond an attorney that it's worth their price?
For who? So yeah, so if you're a seller, I think it absolutely does. I mean, the right broker, I mean, it depends on if you have the right broker. I mean, some brokers don't add any value, perhaps, or actually detract from value, but a good broker will get you a higher multiple and will help you early on to prepare your business for sale and make sure the business is reflected in its best light. From a buyer's standpoint, if the seller has a broker, it's excellent because it doesn't cost you anything, and it makes your attorney's job easier, which makes your attorney's fees lower. So the more professionals that are involved, the more streamlined the deal generally goes. As long as they're qualified and have experience and are rowing in the same direction to close the transaction.
Gotcha. Okay. Thank you. Couple more people typing. We'll just take another question or two and wrap it up here. And if anyone else has any other questions, they can always reach out to Wright. So we'll just wait here for another minute or so. And what should seller expect, i.e., how does the process affect the seller, particularly when they'd still be dealing with day-to-day operations of the business? It's a good question.
Yeah. So running your business is a full-time job, or, maybe more than a full-time job. And a lot of people would say it's like 1.5 full-time jobs. Selling a business is also a full-time job. So that's just another reason to start the process early, is because it requires a ton of effort and time. And, I've been on the phone or, talking to people at midnight, because that's the only time that they can get to actually do the things that we are asking of them to get this transaction closed. And so it can be very tiring for the seller. So I wouldn't recommend waiting until you're too tired and you're ready to retire to sell. I mean, you want to plan ahead. It can be a lot for the seller. And to George's point, having a broker really takes a lot of the heavy lifting off the seller's back and helps guide the seller through the process. So, does it cost money? Yes. Should you probably get more for your business if you have a broker? Probably yes. Does it make the process a lot easier on you as a seller? Absolutely, it does. So if you have a good broker, it's another reason to do it.
Okay. Last question here we'll take. What are there reasonable limits to retaining owner/sellers, time limits or holdbacks of funds?
Yeah. So for SBA finance transactions, 1 year is the limit. They won't let the seller stick around after that. Holdbacks and escrows, usually the buyer will come in and say, we're going to do a 2-year escrow or a 2-year holdback. The seller will then say, no, how about a year? And everybody meets at 18 months. I mean, it's generally the way it goes. Some people just cut to the chase and we just go straight to 18 months, which is great working with lawyers like that. Keeping sellers on, if you're going to make major changes to the business or the culture or the technology or the way it's run, or even somewhat minor changes, the seller may then be more problem than they're worth keeping around. So ideally, when you buy the company, you want to just, shadow the seller, maybe shadow the seller for the first 15, 20, 30 days and just take notes. How do they do this? Why do they do things the way they do them? Because obviously you thought the business was good enough the way they ran it to buy it. So they must be doing something right, and they've been doing it for a while. And then maybe they have them shadow you then for another period of time while you run the business. And maybe just don't make any major changes until you're ready for them to kind of be done. And when you're ready to do everything without them, then you make those changes. So, I mean, 90 days to 6 months is probably sufficient for most purposes. If they want to stay and work, then yeah, you could keep them there for a year. But I generally would not want to make that. You still want it to be an at-will employment relationship in case things don't go very well.
All right. Well, thank you so much. We'll finish right there. If you guys have any other questions, please feel free to reach out. Like Wright said, you'll be getting this recording later today, so keep an eye out for that. And thank you so much for joining. Thank you so much, Wright, for answering these questions in such a detailed form. It's been super helpful.
Thank you, everybody, for coming.
Yes. All right. Bye, everyone.